Hello everyone, this is Kirk here again at optionalpha.com, and in this video we're going to be talking about simple moving averages. It's one of the easiest and most widely known technical studies out there. So some background, simple moving averages are perhaps the oldest and most widely used technical indicator, and I guess what makes them a favorite of investors is because it gives a simple signal. It's very easy to understand. The calculations are very easy to understand as well. They're calculated by adding the prices over a given number of periods and then dividing by the sum. So just taking, again, like the name suggests, an average, and that average continues to move. So every day a new data point is added and one is thrown out. So for example, a 15-day simple moving average would add together the closing prices for the last 15 days and then divide that number by 15. That point would be plotted on the chart. The next day, it would add the previous 15, dropping the last one out and adding the new day and then plotting that point on the chart as well. So simple moving averages are reactionary indicators, meaning that they don't predict future price movements. I guess nothing really predicts future price movements. We don't know. But simple moving averages react to current markets. So they take a little bit of time to react. Shorter term moving averages are more sensitive because you're calculating more recent data. And then longer term moving averages like 100 or 200 or 250-day moving averages obviously are going to take a long time to turn and roll over and move because they have so much data to work with. So it's going to take a long time for that 200-day or 100-day period to move closer to the current market. The indicator formula, like I was talking to you guys about, is just taking the previous closes of a given period and then dividing by whatever the number of periods is. So let's just take this example. So we have a 4-day moving average. We have closing prices of 24, 26, 28, and 25. So we add up all of those and that gives us 103. We divide by 4, which is just the number of days here, and that gives us an average of 25.75. Let's say that the next day comes and the closing price is $27. So what we do is we take those next 4 days, we drop out the previous day, divide that number by 4, and you can see that our average has moved up a little bit, and rightfully so because the closing price is now $2 higher than the previous. Again, let's just keep doing the same thing. We add another closing price, we drop the last two, we keep moving and using the most recent data, and now our moving average continues to move higher. So you can see how our average just moves higher. Again, this is very, very easy, and these numbers would then be plotted on the chart of the stock. So how to use it? Well, there's two major ways to use simple moving averages in your trading. The first is that you want to see the price of the stock go above or below the moving average, and that would be your signal, your breakout signal. If the stock price goes above or below the simple moving average, you'd buy or short the stock. The second way to do it is to use a combination of long and short-term moving averages that cross. So when the shorter-term moving average crosses above the longer term, that would be a bullish breakout. And when the shorter-term moving average crosses below the longer term, that would be a bearish breakout. So let's actually take a look at some of these on my Thinkorswim chart here, and I'll bring it up. So I have up here a chart of Apple stock, and so what we're going to do is just take a look at some of the moving averages. I'm going to use this cool tool, my highlighter. But you can see up here in the left-hand corner that I have two moving averages on here. I have a green moving average and a blue. Now the green is a 200-day moving average and the blue is a 50. So notice how the green line is a little bit more steady. It takes a long time for this to really turn over. So the green line just continues to be a little bit slow. Versus the blue, which is only 50 days, it's more reactionary to the market. It moves a little bit faster with the overall price changes. So if we were using just a simple cross of the moving average, let's say we're using the 200-day moving average, which would be this one that I'm highlighting right here, then as soon as the stock crosses below that point, and we're just using a simple stock closing below that area, then you would sell the stock at that given signal. As soon as the stock closes above that moving average, then you would buy the stock at that given signal. Again, that's just using the simple prices. Now, if we were using it as a moving average cross with the longer term and the shorter term, we would be looking for areas like this on the chart where the shorter term moving average crosses the longer term. Now, in both of these instances, the shorter term is going to cross. In the first instance here, where my cursor is now pointing, this is a bearish moving average cross because the short-term trend is now below the long-term. So you would sell as soon as you see this signal, you would sell. And that actually turned out to be a pretty good sell signal if you could get out. Now over here, where the shorter term moving average crosses above the longer term, that's a bullish signal. So you'd actually buy at this point because the short-term trend is now eclipsing the long-term trend. And you can see that ended up being a very good signal as well on Apple stock back in 2009. So hopefully this has been helpful for you guys to understand a little bit more about moving averages. As always, I appreciate you guys watching this video, and take just 2 seconds to share this video right below here with any of your friends, family, or colleagues on your favorite social network.